Tutorial 1. Continuation of accounting cycle concept. This is our lesson 11 about trading, profit and loss account. Remember, it's with Dr. Geoffrey Mbova of accountingnest.com. Most welcome. Now, the preparation of trading and the profit and loss account is the last step in our accounting cycle. So how do we define trading, profit and loss account? Now, trading, profit and loss account is a financial statement prepared by the business at the end of the financial period to determine the profitability of the business. So let's go to the case of trading profit and loss account format. How is the format of a trading profit and loss account? And again, how many types of trading profit and loss account formats do we have in accountancy? So first, I want you to note that just like in the case of balance sheet, in our discussion, in one of our topics in accountingnest.com website, we have clarified the different categories of balance sheet formats. Similarly, trading profit and loss account has several formats, and the most key ones are the vertical format, the horizontal format, and the three we have got what we call the comparative format. Now I want you to note this, that the vertical and the horizontal formats are not of comparative design. In other words, the way vertical and horizontal accounts are prepared, you may not be in a position to compare two assets of information. But notably too, I would like you to note the following, that comparative trading profit and loss account may assume a report between Roman 1, a case whereby we are comparing two or more periods of a particular organization. In this case here, we will be looking at the trading profit and loss account for financial year 2020 and 2019. Those are two periods, but of the same company or firm. Or the trading profit and loss account format can take a comparison of information between two or more firms. In this case here, we may be looking at the trading profit and loss account for company A, company B, and company C, which may be they are all operating in the same industry. And then lastly, that is Roman 3, the information under comparative aspect may take the form of a comparison between a firm's trading profit and loss account and the industry's trading profit and loss account. In this case, we benchmark the individual outcome of a single firm vis-a-vis the average trading profit and loss account of an industry. Right? The next, before we look at how these entries are normally recorded in the respective trading profit and loss account, I would like to remind you as a learner in accountancy that as we go forth to do recording of business transactions in the respective trading profit and loss account to determine the net profit of a business, it's good to remember that applicability of matching principle and accrual concept is very important. That is, preparation of trading profit and loss account is pegged on the aforementioned generally accepted accounting principles. Now, the following scenarios then, with that in mind, will guide you on how to determine the net profit of the business under different assumptions. So let us now go ahead and look at scenario 1, and I'm using the case of XYZ business. Now in scenario 1, I'm considering a case whereby this business has got only trading income and the trading expenses. Now that is, sales for 1 year was $200,000 US, while purchases for 1 year was $70,000 US. So if you are to determine the profit of this business, how do we go about it? There we go. That is XYZ Limited Company trading profit and loss account, whereby we have got the debit side and the credit side. Amounts are indicated as you can see on the screen. Then we start with the entries of sales. Sales were amounting to 200,000, while on the other side we have got purchases, whereby the amount was 70,000. Now that there are no opening and the closing inventory, and again there are no operating expenses or operating incomes, we have got only those two aspects, that is income of trading nature and the purchases of and the expenses of trading nature. So the difference between the two, that's 207,000, is a clean 130,000. Now this represents the gross profit of the business, and therefore the gross profit will be carried down as CD to balance the two sides, that is 130,000, which again is transferred or recorded on the credit side as net profit brought down of 130,000. Now, why are we having a difference in the recording on the debit side, where we are talking about gross profit, and when it comes to the credit side, as we post the same amount as balance brought down, we are referring that as net profit? This is because since we have got only two aspects, that is income of trading nature and the expense of trading nature, and no more transactions thereof, that is, there is no operating expense and no operating incomes to consider. In this case, then therefore, the gross profit still represents the net profit of this business, and that's the reason why the balancing figure is gross profit stroke net profit carried down, because the two are just one and the same thing. So that is how to record and to determine the net profit of the business, given a scenario 1 whereby the two items are both of trading nature. Then when you go to the second scenario, now in this case, we have got introduction of operating expenses and operating incomes. So bearing in mind that we have got the original facts, that we have got sales of 1 year of 200,000 and the purchases for 1 year of 7,000 as seen in the case of scenario 1, in addition to this information, we are told that there was operating expenses which were of electricity, insurance, and rent kind, amounting to 90,000, and also operating income, that is commission received and discount received of 20,000. Now with this information, we can prepare the same accounts of XYZ company to determine the net profit of this business. That is, for the debit side and the credit side, And then we have got the recording of figures. Initially, we had a total of gross profit of 130,000, which will be brought down as 1,000 on the credit side. Then in addition to this, we add other incomes, that is operating income of 20,000. And on the debit side, we consider lessing or doing a subtraction of operating expenses, where we have got 90,000. Now the two sides, the credit side is more, it has got 150,000, while the debit side has got 90,000. The difference between the two, obviously, it will represent the net profit carried down, whereby the two sides will balance at 150,000. Then don't forget that the net profit carried down will appear on the credit side as a net profit brought down of 60,000. So you see, that is how to determine the net profit of our business using a trading profit and loss account tool. Now let me go to the last scenario, that is scenario 3, where I'm taking a full throttle, considering all aspects that are required for preparation of a trading profit and loss account. Now in this books of XYZ business, we have got opening inventory of 3,000, closing inventory 7,000 US dollars, then sales for 1 year still remain the same as 200,000, and sales returns, or what we call returns inwards, was of 30,000 US dollars. Then purchases again maintains its status quo as it was in the scenario 1 and scenario 2, that is 70,000 US dollars. Then carriage inwards, what we refer to as transport on purchases, is of 10,000, with returns outwards of 8,000. Then operating expense and operating income still remain the same. Now with this information, I now know we are going to get an in-depth analysis of how to determine the net profit of this business. There we go. We have got debit and the credit side, whereby we have got, for example, the sales for the year was amounting to 200,000, but we need to net this with returns inwards. That is, we less 30,000, translating to 17,000 as a net sales. Now with this in mind, we go to the other side and look at the inner details. We have got the opening inventory, which was amounting to 3,000. Then we have got the purchases of 70,000, which we need to add carriage inwards of 10,000, which will translate to 80,000. Now with that in mind, the total or the sum of open inventory plus purchases and carriage inwards, it translates to 83,000. Then we need to consider we less returns outwards, which was amounting to 8,000, and this gives us the cost of goods available for sale for the whole year, which was amounting to 75,000 US dollars. But you see, with the matching principle, we need to consider the inventory, the closing inventory, which is actually part of cost of goods available for sale, because this inventory was not sold. So for us to do a proper matching, we less the closing inventory, which was 7,000, and this gives us a cost of goods sold to be translating to 68,000. Now, with a matching principle, it is now possible to compare the net sales of 17,000 and the actual cost, the net sales that were made, their cost was 68,000. Now with the two we can compare and determine the gross profit carried down, which is actually the balancing figure, and it is 102,000 US dollars. You see that? Now I want you to notice something, that in the case of preparation of trading profit and loss account, actually these are two financial statements in one. Only that is a common practice that we don't separate the two because it will turn out to be a bit cumbersome. But that first tier of entries, it represents the trading account, which is a financial statement that is prepared to simply to determine the gross profit or the gross loss the business has made so far. Then the next level you are moving into, we want to factor in other aspects of profit and the loss account. And how do we go about this? First of all, the two sides are being balanced at 17,000 each side, and then the gross profit carried down will be recorded on the credit side as gross profit brought down, which was 102,000. Now, in addition to this gross profit, then we need to factor in additional or operating incomes, whereby in our case we have got 20,000, while on the other side we consider to less operating expenses, whereby in this case we have got operating expense amounting to 90,000. Now with this in mind, you realize that the credit side has got a total of 122, while the debit side has got a total of 90,000. The difference between the two then becomes our balancing figure, which is the net profit carried down of that 2,000. Mark that. That means the two sides will balance at 122,000 US dollars. And this now means that the net profit carried down will appear as net profit balance brought down as shown in this on this wall. So far so good. Now, with that in mind, I want to take you back to the accounting cycle and remind you that in this process of accounting cycle, remember we started with balance sheet, the original balance sheet, which is also referred to as the statement of financial position. And this statement was representing the financial position at that very beginning time. But then after that, we had several steps that followed. We have got the ledger accounts, then the trial balance, and then the trading profit and loss account that we have just prepared represents the fourth step in accounting cycle, which is actually the last step in this process. Now in our case here, we have realized that the business had made a net profit of that 2,000. Now these are 2,000 supposed to be added back in the original capital amount so that we can decide or determine the new statement of financial position of this business. So here we go. That remember that the original balance sheet was with us there, whereby it was followed by a ledger account, whereby transactions were recorded there. Then after that, we had preparation of our trial balance, and then after the trial balance, we had the trading profit and loss account, as I've just said. Now I want you to note this, that the outcome of the trading profit and loss account, which in this case here is a net profit of that 2,000, should be added back to the capital, the original capital of this business, so as to determine the current financial status of the business after 1 whole year or after the financial period. So I want you to note this, that in the accounting cycle process, all transactions will start with an original balance sheet. Alright? And again, at the end of it all, the process ends up with an updated balance sheet. Therefore, we are saying, in a nutshell, that the original balance sheet, which is also referred to as the statement of financial position, is followed by transactions that take place after the business has been financed by the owners, whereby the transactions are again summarized are recorded in a ledger accounts, whereby they are normally balanced at the end of the financial period, so as to extract the balances brought down and the totals of the respective ledger accounts. After that, we prepare a trial balance, which is actually a summary of account entries. But before we go very far, I want you to note the following, that practically, accounting cycle starts at the balance sheet point. Then transactions are normally recorded in the source documents. Then from the source document, the information is transferred to books of original entry. Assignment number 2, we talk of transfer of information from the source document to the books of original entry, but not posting. Why? Out of curiosity, can you find out? Then we post in the respective ledger accounts the summary of entries that are made in the books of original entry. Then get advised that you need to visit our accountingnest.com website for more details about these entries. Just go to financial accounting window, the intermediate level, and then you'll see how accounting cycle in details is normally operated. Now back to track. So after trial balance has been extracted, the next step is then the preparation of trading profit and loss account, so as to determine the organization's profitability level. And finally, after that is determined, as we have just seen in our case, where we have gotten about $2,000 profit, net profit, then we extract or we prepare a new balance sheet, that is statement of financial position, which will be representing a new financial position of the business. Of course, like in this case, you realize that the financial position of this business will have improved because the business generated some additional profits, which are increasing the capital base of this organization. Otherwise, if it meant losses, then the new balance sheet, which is a financial statement, it will be portraying a lower financial position of the business. So this marks the end of our 11th lesson. I would like to take this opportunity to invite you in our tutorial number 2 in another advanced level in this accountancy program. Thank you. Remember, our materials and notes are available in our website accountingnest.com. Thank you.